I have been investing in the stock market since the day that I've turned 18, and in this video I want to give you a complete beginner's guide to stock investing, so even if you have absolutely zero knowledge, by the end of this video, you're going to be able to grow and multiply your wealth. Because debt is at an all-time high, tensions are building around the world, choosing your stocks wisely has never been more important than right now. No one can tell for sure if this year is going to bring record highs, or if there is a market crash or bear market right around the corner. But if you do choose your stocks wisely, you should be able to forge ahead with more gains than ever. If you can focus on quality companies and ETFs, I promise you that your investment portfolio is going to do a lot better long term. Even if you bought stocks right before the pandemic in 2020, where it dropped over 30% within the span of 2 months, you would still come out on top with the market soaring to new highs in 2023. What this isn't is another get rich quick with stock videos that cram YouTube, telling you that stocks are the end all be all to growing wealth. In fact, there's times in this video where I'm going to advise you not to invest in stocks. This video will help you exceed not only in up markets, but also in down markets too. Bull and bear markets will come and go, but the informed investor is going to keep making money no matter what. So here's what we're going to go over in this video. We're first going to start with the essentials of stock investing, and then I'll tell you what you need to know before you start buying. I'll then show you how to pick winners, move on to some investment strategies and tactics that you can use, and then I'll finish off by telling you the strategies that I personally use and the pitfalls to avoid. So sit back, grab a notebook, and get ready to learn. So just so we're starting off on the right foot here, let's talk exactly what a stock is. A stock is a small ownership in a company. When you own that stock, you actually own a small part of that company and can benefit from its success. Consider stock investing like buying eggs from a grocery store. In this analogy, the grocery store would be the stock market, the eggs are the companies, and then the price of the eggs is what you're paying for those stocks. If you have two brands of eggs that are similar, one is $2.99 and the other one is $3.99, which one are you going to choose? You would probably look at both brands and judge them by their quality. And if they're similar, you would take the cheaper eggs. The eggs at $3.99 would be considered overpriced. The same thought process applies when you're buying stocks. If you compare two companies and they're very similar in every aspect, except their prices, you would go with the cheaper one. But the egg example has another side to it. What if those two brands of eggs were completely different? What if one of them was stale and old and gross, and the other one was fresh and of superior quality, but priced $1 higher? You would probably go with the $3.99 one because you're still getting more value from it. Maybe you would buy the cheaper eggs if they were placed at $1.99, but at $2.99 they're overpriced. The same example works with stocks. Don't buy stocks from a poorly run company if you can buy stocks from a better run company for the same or better price. Another very important thing that we have to go over is the market cap of stocks. This is short for market capitalization, and it is the total value of a company's stock. It's calculated by multiplying the company's stock price by the total number of shares available. For example, if a company has 1 million shares that each cost $50, that company's market cap is 50 million. The higher the market cap, the bigger the company is. The first category of stocks is microcap. These are the smallest, hence the riskiest stocks available. Microcap stocks have market caps under $300 million. You then have small cap stocks, which are going to range from $300 to $2 billion in market cap. These fare a lot better when it comes to survivability and still have plenty of room for potential. The key word here is potential because they usually still have a lot to prove. You then have medium cap, which is $2 to $10 billion. These tend to be the sweet spot between small and large cap stocks because they're still big enough to provide a lot of safety, but they also still have room to grow. There's then large cap stocks whose market cap ranges between $10 and $200 billion. These are usually best reserved for the most conservative investor who wants steady appreciation with greater safety. And then the last category is ultra or mega cap stocks. These stocks obviously refer to the biggest of biggest stocks. They're like the megalodons among sharks. Think Google and Microsoft. You can compare stocks market cap to trees. Which tree is sturdier, the California redwood or a small oak tree that's just a year old? If a storm comes, the redwood's going to hold up a lot better than the oak tree, but that small oak tree has a lot more room left to grow compared to the giant redwood. Now that you understand the basic terms, here's a couple things that you should ask yourself before you start investing, and that is to determine your goals. Are you investing for retirement in 20 years? Are you already retired? Do you want a couple hundred or a couple extra $1,000 a month in income? Stocks are a means to an end. Before you get started, know exactly what you want from investing. Now, before you hop on a brokerage and start buying, let's talk about a couple more things that you need to do before you start investing. The first and the most important thing is to make sure you have an emergency fund. That's where you have a reserve of cash big enough to cover 3 to 6 months worth of your living expenses. 6 months is usually enough to get you through something like a job loss or any other emergencies where you don't have to sell off all your stocks. Now, everyone says that you should have an emergency fund, but most people don't realize just how important it is, and a lot of people like to skip over this step before they start investing. But I can tell you from personal experience, this is one of the most important things you can do. This is actually the biggest mistake that I made. Right after I turned 18, I put all the extra money that I was earning from my restaurant job into the stock market. And then about a year later, I went to college and ended up being short on money and had to sell a lot of my stocks at the bottom of the market. And if I just saved up a couple extra $1,000 before I put it into the stock market, I could have avoided that. So make sure you go and calculate your monthly expenses. Let's say it's $2,000 for example. Make sure you have at the very least $6,000 worth of cash, but aim for closer to $12,000. Put it in a high yield savings account so it's not hurt by inflation, and then just leave it there. If you need a high yield savings account to put it in, I put mine in UFB Direct. SoFi is also good, and then Discover, Capital One, and American Express all have good savings accounts. You also then want to make sure that you don't have any high interest debt. The stock market will give you an average of 10% each year, but that's not going to matter if you have an auto loan or credit card debt that's costing you between 20 and 25% in interest. You can start investing if you have debt with a lower interest rate. Let's say you have a car loan with a 3% interest rate. It might be okay to carry that because you'll be earning 10% in the stock market. But make sure you pay off anything above 7 or 8% before you start putting money on the stock market. To buy stocks, you're going to need money. That means you need a positive cash flow. What that means is that you have more money coming in your bank account than you're spending. If you're spending more than you're making, then you need to take a serious look at your budget. But if your income is greater than your outgo, then you're ready to start investing. And no matter how small the amount is that you have to invest, it'll still definitely help. I've seen people start with investing $25 or $50 a month and amass a fortune over time. Stock investing is best suited for making money over time. Usually when you measure stocks against other investments in terms of 5 or preferably 10 years, they excel. Even an investor that bought stocks in the depth of the Great Depression saw profitable growth in their stocks over a 10-year period. In fact, if you look at any 10-year period over the last 50 years, you'll see that stocks beat out all other financial investments like bonds or bank investments. But investing does come with a whole lot of risk. Investors deal with risk in the form of losing some or all of your money. But risk isn't scary if you know exactly what it is and how to plan for it. The most basic rule of investing is the bigger the risk, the higher the potential reward. In terms of financial risk, the bottom line is, well, the bottom line. If a company is making money, then you can go ahead and invest in it. However, if a company is losing money, then you're not going to profit by investing in their stock. Profit is the lifeblood of any company. However, there are still outside risks that can affect a company besides just profit. For starters, there's interest rate risk, because when interest rates rise, the cost of borrowing money also rises, reducing those companies' profitability. When a company's profit drops, the stock becomes less desirable, and then the price of that stock is going to fall. You can take Home Depot as an example. Between 2005 and 2006, the company was doing great because of the housing boom. There was lots of new buildings, repairs, and upgrades going on. But after the housing bubble burst, Home Depot's business took a big hit. The stock was $44 in 2005, but dropped all the way to $21 after the housing bubble popped in 2008. That is a 52% drop in just a couple of years. So in an example like this, you can see that even though Home Depot is a super solid company, they can be heavily affected by things like interest rates because their business model depends so much on it. There is also market risk. There's millions of people around the world buying and selling stocks every single day. When people buy more of a stock, it goes up, but when people sell a stock, it goes down. This back and forth of supply and demand is what makes a stock price change. There is also inflation risk. For consumers, this means higher prices for goods and services, which in simple terms just means your money isn't buying as much as it used to. For example, in 2023, food prices went up by 17%. For you as the investor, that risk means that your stocks may not always keep up with inflation. There is also political and governmental risks. If companies were fish, policies and government policies would be the pond. In the same way that fish die in polluted or toxic ponds, government policies can kill companies. For some companies, a new law is enough to make them go bankrupt, while that same law can boost other companies' profits. A lot of times, the risk isn't even directly related with the investment you make, but rather the investor. Let's say someone buys $10,000 worth of Costco stock, and then the value of the stock temporarily dips down to $8,000. If that investor loses their job or something else happens and they don't have an emergency fund, they might be forced to sell and take losses, even though they invested in a good company that will recover and make profits long term. There is also a lot of emotional risk that comes with stock investing. There's 3 primary emotions that come into play. There's fear, greed, and love. If you get attached to a sinking stock, you don't need a stock investing video, you need a therapist. You also don't need to be an expert to see the consequences of greed in the stock market. Every couple of years, there is a new stock or segment that causes millions of investors to just throw caution to the wind. In 2018, it was marijuana stocks that fell sharply in 2019 and 20, and then in 2021 and 2022, stock investors were going crazy over EV stocks, which besides Tesla have all significantly fallen. But fear is the other extreme. People that are too scared of loss a lot of times avoid good investments and settle for lower returns. People also have a very hard time stomaching volatility. Volatility is how much a stock goes up and down. Some stocks are a lot more volatile than others, but overall the market is a lot more volatile than it was, say, 10, 20 years ago. And the reason is that now people all over the world can download an app like Robinhood and instantly buy and trade stocks in a second. Years ago, if someone wanted to sell a stock, they had to call their broker, usually during business hours, and then on top of that, there would be like a $30 commission fee. That discouraged a lot of the rapid fire trading that's going on today. Now, before you go crazy and think that stock investing is way too risky for you, minimizing your risk in stock investing is actually a lot more easier than you probably think. Most people spend more energy analyzing which $20 menu item to get than they do deciding where to put their next $5,000 worth of investments. Lack of knowledge is the greatest risk for new investors. The more familiar you are with the stock market, the better you can navigate and avoid its pitfalls. Diversifying your investments is also a great way to reduce risk. A couple quick useful tips is number one, don't put all your money in one stock, don't put all your money in one industry, and don't put all your money in one type of investment. I recommend only keeping 5 to 10% of your total investment portfolio in a single stock. Also, when it comes to investing, there's more than one way to do it. Buying stocks directly can be good, but what I like even better is buying stocks indirectly, and I do this through an ETF. An ETF is like having a basket full of stocks. Imagine if you go to a supermarket. You can buy individual fruits like one banana, one orange, one apple, or you could buy a mixed fruit basket that has a little bit of everything. The basket is the ETF, and all the different fruits inside are the investments. If you're a complete beginner and don't take anything else from this video, just set up a reoccurring buy every month that goes into the S&P 500, which is the 500 biggest and most important companies in the US. The S&P 500 beats even professionally managed portfolios 80 to 90% of the time. There are also great ETFs outside of the S&P 500. Let's say you're a beginner and you want to invest in something like energy, but don't know or trust the companies enough to invest in them. You can get an ETF with all the best companies in that sector. There are also ETFs that can match your personal investment style. Let's say you're closer to retirement and you want stocks that focus on supporting your income. You can buy high dividend income stocks, which will usually give you 3.5% or higher. There's even bearish ETFs. These go inverse to normal ETFs. So let's say the market takes a big dip, then these will actually shoot up. However, I usually suggest that people avoid these because it's more gambling than investing at that point. This is something that I ended up losing money on earlier on in my investing career because I was very young at the time and I would watch all these finance YouTube videos telling me that there was going to be a big crash. So I would put money in these thinking that there was going to be a crash, but it never came. And I just lost that money. The two most important things when it comes to investing is number one, knowledge, and then number two, information. If you go into investing without having these two things, it's like diving into a pool that's only 1 inch deep. There's always going to be opportunities to make money in the stock market, no matter how poor the general economy or market is. So the best way to go about investing is to first get knowledge and information about the company that you want to put your money into. And there's 3 primary things that I like to look at. Number one, is that company financially sound and growing? In a minute, I'll teach you how to look at a company's financials to figure this out. You then want to make sure that company actually has products that are in demand by consumers. You don't want to go and invest in a company that's making paper umbrellas. And then you also want to make sure that company is in a strong and growing industry. You're also going to need a grasp of basic accounting and economics. And trust me, I know those things sound boring. Accounting classes are some of the most boring classes I've taken in school, but what I'm going to be teaching you in the next couple minutes is really easy to understand. In fact, you're probably already familiar with most of these without even knowing it. First, you're going to want to know if that company is using their money wisely. When they get money, do they reinvested back into the company? If you want to find all the numbers on a company, I use stockanalyst.com and that tells me all the company's financials, balance sheet, all that good stuff. You're going to want to do something called a comparative analysis. And that sounds complicated, but really all it is comparing how a company is doing right now to how they were doing or how another company is doing. For example, let's say a company is profiting $100,000. It's definitely a good thing that they're profiting, but it might not actually be a positive sign if they were profiting, let's say, $500,000 the year before. And then the other thing that I mentioned, economics, is also something that you're going to want to have an understanding of. Don't worry, you're not going to have to understand the elasticity of demand or marginal utility or any of that stuff. I just want you to chew on 2 primary ideas. Number one is cause and effect. If a business says something like, we expect coffee sales to double or triple in the next year, you might want to think of the effects that might have. For example, is that going to increase the sales of milk as well? Is that going to lead to a decrease in something like green tea? And how would that affect those different companies? You can also learn from past mistakes in the market. It's that whole idea of history repeating itself. And a lot of times there are clues to when a market might go up or down. For example, in 2007, a lot of experts were warning that the markets were overvalued, and because of that, a big crash could be looming. And then if you look at the crashes in 2020 and then 2022, the PE ratios of the company were way too high, and a lot of stocks were just overbought. So by studying the past, you can get a better idea for what's going to happen in the stock market in the future. Here are some of the biggest takeaways that I've personally found after studying the stock market. Number one, stocks aren't a replacement for bank. Make sure you always have money in the bank, i.e. an emergency fund. Number 2, stocks should never account for 100% of your investment profile. You could go with things like bonds, physical real estates, maybe a little bit of crypto, even some physical commodities like gold or silver could be a good idea. My next takeaway is keep your debt and expenses to a minimum. What you make is just as important as what you spend, and all those minimum monthly payments do add up. And then my last takeaway is if the economy is booming, there's eventually going to be a decline. And that's not even a bad thing. That just means that there's better buying opportunities. That's just the way that the business cycle works. You always want to make sure that you're staying up to date on financial news. And this doesn't mean turning on the TV and watching the talking heads say, oh, the Dow is up 3% and these are my top 5 growth stocks for the next 2 days, whatever. Don't worry about that. My favorite 2 things to read every day is number 1, the Wall Street Journal, and then number 2, Investors Business Daily. Some of my favorite websites also include MarketWatch.com, Yahoo Finance, and then Bloomberg. These websites and journals do a really good job of keeping you up to date of what is going on with the stock market as well as the general economy. Now, let's say you do all that and you see a company that you're ready to buy. If you go on something like Robinhood, you're going to see a stock table. And if you're a beginner just looking at all that stuff, it can look like pig Latin. So let's go ahead and break down what's in a stock table. So if I go to Robinhood and then click on the Apple stocks, you'll see a bunch of information there. This is called the stock table. So first up, you have market cap. We talked about this at the beginning of the video, but this is just how big a company is. You can see that Apple is an absolutely massive company with a $3.35 trillion market cap. We then see the dividend yield. Apple's is 0.44%. What this means is Apple pays out dividends equaling 0.44% of the stock price annually. That is a relatively low dividend payout. So what that indicates to us is that they're more focused on growth than they are high dividend payouts, which makes sense because they're a tech company. We then have the average volume. This is the number of stocks traded of Apple a day. A high trading volume like Apple's indicates that this stock draws a lot of attention from investors. The volume tells us how much of it has been traded today. It's sitting right above 45 million, which is a little bit under the average, but the day isn't over yet, so that will probably be closer to the average. There is then the daily price movement. You can see that the highest price there was today was $226.29, and then the lowest you could buy the stock today for was $221.41. And then the open price tells us how much Apple stock was trading when the day began and the markets opened. We then have the 52-week range. This tells us within the last 52 weeks how high the stock price was and how low it was. This just gives us a pretty good gauge of the range that this stock has traded in within the last year or so. You can see that Apple's high was 260 and then the low was 164. So it's trading right in the middle right now. And then lastly, and one of the more important things is the PE ratio. This is the price to earnings ratio, and it pretty much tells you how expensive or cheap a stock is. People usually consider a good PE ratio to be between 10 and 20%. You can see that Apple's is 36.62, which is quite high, meaning a lot of investors are betting on future growth of the company. So a company that we just looked at, like Apple, would be considered growth stock. So what we've talked about up to this point might help you narrow down your stock choices from maybe a couple thousand to a couple dozen or a couple hundred. But in this next section, I really want to help you narrow down what you want to buy. So first, ask yourself if a company has a strong brand name. A company like Microsoft and Coca-Cola have a lot of recognition. Sure, another company could come along and make software, but because it doesn't have a lot of the brand recognition that a company like Apple or Microsoft have, they're going to have a hard time actually getting people to use it. I also like to pick stocks with a high barrier of entry. For example, a company like UPS or FedEx has such a big distribution and delivery network, so not anyone could just come in and start a delivery service. You know, it takes a lot to get going. I also like to look at a company's fundamentals. A lot of people call this fundamental analysis. What this does is pretty much just tell you if a company is in a good financial situation. For example, if we look at Microsoft, you can see that their revenue has been growing every single year. Since 2020, it's grown above 13% besides 2023. Usually you want to see a company's earnings on average 10% higher than the previous year. You also want to evaluate a company's management. Obviously, if you go ahead and call it Microsoft, you're not going to get a lot of information on how they manage their company. But what you can do is look at their return on equity. That is in their income statement, and usually that will tell you how good a company is being managed. 10% is good, but usually you want to see around 15%. If you go through a company's financials, there's 100 different things that I could talk about for hours, but the most important thing to me is if their net profits are growing every single year. And if you look at a company like Microsoft, you can see that it is growing every single year. Now, their PE ratio is very high. I bought a little bit of this stock back in 2022 when the PE ratio was around 26%, but you can go through their financials and decide for yourself. Another thing that I want to talk about before I wrap up this section of the video is income stocks. Now, a lot of people, especially younger people, invest in stocks for growth. But there are also a lot of stocks and ETFs out there that will continue to grow, but also give you a dividend payout, which can act as income for you if you're older or retired. And there's a couple good reasons why I really love income investing. Number one is it protects pretty well against inflation. Most income stocks give you around 3.5% of dividends each year, so that usually beats off inflation. There's often lower tax rates on the dividends that you get from your stocks compared to interest on a savings account or regular income. I like these a lot for older people that are getting ready to retire, but I do have an income stock ETF in my personal portfolio, and I just have the dividends automatically reinvest and buy more of the stock so it grows that way. They are also considered defensive stock, meaning that they fall less when the total economy goes down, because often those companies sell things that people are going to need regardless of what state the economy is in, whether that's drink, food, or utilities. Now, before you go on your brokerage and fill your whole portfolio up with income stocks, there are a couple quick disadvantages. Those stocks can lose value just like any other stocks, so you could lose money in your investment and also get a lower dividend payout. Also, a lot of times when interest rates are up, income stocks can go down a little bit, because why would you put money in a stock that's paying you 3.5% in dividends when you could put it in a high yield savings account that's giving you over 5%? I personally buy income stock ETFs, so it's a full basket of them. But if you do want to buy an individual income stock, I would first look at their bond rating. A bond rating pretty much tells you how strong a company's financials is, and this is very important for income stocks because you want to make sure that they're actually going to be able to pay their dividends to you. AAA is the highest, it then goes to AA, BBB, and then you get the point. It goes all the way down to D, where D is the lowest. My two favorite types of income investments are number one, utilities, because people are obviously always paying utilities, and these companies tend to give you a very high dividend. I also love REITs. That is short for a real estate investment trust. These are companies that own, operate, or finance income producing real estate properties. REITs allow investors to pool their money and invest in large income generating real estate properties without having to directly buy or manage them. I have a small portion of my personal investments into a real estate investment fund, and because I'm young and I don't need the extra income right now, I just have the dividends go and automatically buy more stocks. I think this is a great way to diversify your portfolio, and I think that this is a great income investment for people that don't have money to actually go and buy real estate or newer investors. Of course, there's risks with it, just like any investment. REITs rely on borrowing to finance their properties, so when interest rates go up, usually they're less profitable. And then there's also the physical property risk. If tenants vacate or don't pay, or the property goes down, the stock value can go down as well. All right, so now that you're getting closer to actually going and buying stocks, I want to give you a couple recommendations for brokers if you don't have one already. One of my favorites is Charles Schwab. They have a great reputation and is all around a super solid brokerage. Fidelity's also a great investment account, and so is Webull. I personally use Robinhood just because that's what I started with when I was 18, and I've had all my stocks in there my whole life. The user interface is probably the best out there. It's super simple and easy to use, maybe a little bit too simple. It makes things like options trading way too easy, but for me, it gets the job done. I have gold, so I get a 3% match on everything I put in my Roth IRA. It also is giving me 4.5% on my uninvested cash right now, so I'm just using that as a high yield savings account, and I have my emergency fund sitting in there earning that high interest. However, people don't like Robinhood as much because it doesn't have as good as reputation, but as of right now, it's working great for me. I'll have some links pinned in the comments where you can get a free stock by signing up with one of these brokerages. Too often, the only number investors look at is the stock price. Yet what determines that stock price is the company behind that number. To make a truly good pick in the world of stocks, you have to look at that company's financial information. If you pick a stock based on the value behind that company, you are a value investor. Value investors look at a company's fundamentals. This is things like sales, earnings, assets, net worth, and so on to see whether the information actually justifies buying that stock. Like I said, value investors use something called fundamental analysis, opposed to technical analysis. A lot of times that's what day traders or short-term investors use. History has shown that typically the most successful investors are ones that use fundamental analysis and invest in the long term. One of the key tools I use to see if a stock is worth buying or not is looking at its book value. That is a company's total assets minus their total liabilities. This is a really good way of checking if a stock's undervalued or overvalued. A value investor doesn't buy a company stock because it's cheap, they buy it because it's undervalued. We use an income statement to determine a company's profitability. In the days leading up to the famous bear market from 2008 to 2009, many investors lost all their money because they were investing in companies that simply didn't make a profit. Don't be surprised in the next couple years when a lot of AI companies go out of business because they're not making a profit. All right, so now things are going to get a little bit more technical because I'm going to be showing you how to look at a company's balance sheet. But don't worry, this is probably a lot easier than you think. If you can run a household budget, you're probably going to be able to understand understand most of this stuff pretty easily. I'm going to be using Tesla's financials, so you can go ahead and follow along with me. So the first thing that we're going to want to look at is a company's total assets. Have they increased from the prior year? Usually we're going to want to see at least a 10% increase. If we go ahead and look at Tesla's, we can see that their total assets are going up by much more than 10% each year. We also want to look at a company's inventory. If sales are flat but inventory is growing, that might be a problem. We can see that Tesla's inventory has been growing pretty steadily, but their sales have also been growing a lot, so that's okay. Next thing that we're going to want to take a look at is the debt. Debt is the biggest weakness on a corporate balance sheet. If we go ahead and look at Tesla's debt, we can see that it was shrinking, but then recently it went up a little bit, and that's okay. Not all debt is necessarily bad debt. Next up, we have equity. This is going to be the company's net worth if they had to immediately sell all their assets to pay off their debt. This should also be increasing by at least 10% every year. So if we look at Tesla's, you can see that every single year it's been going up. So that's a really good sign. And that's one of the reasons why I'm not tripping over their debt too much. If we go ahead and look at their balance sheet, we can also see what kind of assets they have. As you can see, most of their assets is in property, plant, and equipment. They also have some long-term deferred tax assets, but because they're an electric vehicle charging, it makes sense that most of their money is in their property, plant, and equipment because they need some pretty big spaces to be able to manufacture all their cars. We can also take a look at all their liabilities. You can see that their long-term debt has gone down a little bit and then it spiked up in the last year. As you can see, Tesla's total liabilities have been growing, but that's okay because their equity is growing way quicker, so that debt is mostly justifiable. If we go over to Tesla's income statement, you can also see that their revenue is growing every single year. Their gross profit has been growing pretty steadily, but they had one big year in 2022. One of the only big red flags that I can see here is that their net income has dropped since 2023. So after you go ahead and take a look at a company's balance sheet and their income statement, you can then go ahead and look at the ratios. There are two big ratios that I'm looking at. And by this part of the video, you should already be somewhat familiar with these, and that is price to earnings and then price to sales ratio. So PE ratio is one of the most important metrics when deciding how valuable a company is. This is because it establishes a direct relationship between the company's earnings and the stock price. Buying a company with a high PE ratio isn't always necessarily a bad thing, but it is definitely a lot more risky. Investors buy stocks based on their expectations. If an investor is confident that a company's earnings are going to continue to grow over the next couple of years, then they're okay buying a stock with a high PE ratio. The only problem with this is that if that company doesn't meet those growth expectations, then their stock price can fall pretty dramatically. So let's give a real world example. Let's say that I had a company that sells microphones, and each year I'm profiting about $2,000. If I was looking to sell and you were looking to buy that company and you asked how much I wanted to sell it for, and I said $2 million, you would probably decline that offer. And that's because even though my company is a profitable company, it's going to take forever to actually get your initial investment back. In this example, my company's PE ratio would be 500. But if I offered $12,000 for you to buy that business, it might then make sense because the PE ratio would be only 6, meaning it would only take 6 years to get back your initial investment opposed to 500 like the last one. In general, the lower the PE ratio, the safer the stock is, and the higher the PE ratio, the higher risk the stock is. The company's PE ratio also has to do a lot with the industry. For example, electric utility stocks usually have a PE ratio between 9 and 14%. So if you came across an electric utility company with a 45 PE ratio, something would probably be up. Whereas tech stocks usually have PE ratios between 25 to 40%. So if you were to find a good tech stock with around a 20 PE ratio, that might be a little bit more of a bargain. Also, watch out for stocks that have a negative or don't have a PE ratio of all, because this means that the company is actually losing money. Yes, you can still make money with these companies, but at that point, it's more speculating or gambling than investing. And that's okay as long as you know that going into it. For example, I have Rivian in my stock portfolio, and that company isn't making a profit yet, but it's only like 1% of my total investment portfolio, so I'm okay with losing all that money. Price to sales is very similar to price to earnings, but instead of earnings, it's sales. I like to look at the PE ratio more because, that's the company's bottom line, but I also always look at the PS ratio too. If there's a high PS ratio, something like 10, that usually means that investors are expecting the sales to grow a lot, but that also might mean that the investment's just overpriced. Whereas a low PS ratio like 1 or 2 might either mean that that company is undervalued or that that company is just struggling. Another important thing to look at is the financial documents. Now, a lot of people would rather lick a middle school gym floor than look at these, but they're actually a lot more easy than you think. If you're a regular stockholder, then the company will send you this in the annual report every year, but you can also view a company's annual report on their website, or you could just Google it and you'll find it. So when you're looking at this, you're going to want to think about a lot of the same things when you're looking at a company's balance sheet. Are the earnings growing? How are they compared to the years before? Are the sales growing? Is the debt growing? Is the company making more than it's spending? And what are its plans for the coming years? You can usually find the plan in the letter from the chairman of the board. You also want to see how this company is doing compared to the other companies in the same industry. It should be growing at the same rate or more than all the other companies. Okay, so now I want to pivot a little bit and talk about emerging sector and industry opportunities. Okay, so let's say you go out to Vegas with the boys and you have to pick one of three groups to win a race. Group A is Olympic sprinters. Group B is sleepy turtles. And then Group C is penguins waddling on land. Obviously, you're going to pick Group A. And this is kind of like how industries with stocks work. Obviously, life isn't fair and some industries are going to progress a lot faster than other ones. Also, a lot of investors get industries mixed up with sectors. A sector is a group of related industries. A good example would be healthcare. That is a sector, but it has a lot of different industries. It has pharmaceuticals, hospitals, drug retailers, all that good stuff. And a successful long-term investor looks at the industry or sector just as carefully as they look at the individual stock. Luckily, choosing a winning industry is a lot easier than choosing a winning individual stock. Most industries can be placed in two different categories: cyclical or defensive. This pretty much translates to what a society wants versus what it needs. Society usually buys things that they want when times are good and holds off when times are bad, but it buys what it needs in both good and bad times. Cyclical industries rise when the economy rises and then fall when the economy falls. So if the economy is good and consumers are confident, then they'll spend a lot more money on things that they want. Real estate and automobiles are great examples of cyclical industries. But what about times when the economy is rough? No matter how bad the economy gets, people are still always going to be buying things like food, gas, healthcare, and utilities. So in bad economic times, defensive stocks usually do way better than cyclical stocks. Defensive stocks usually grow in two ways. First is population increase, because when the population increases, people are going to be buying more of the necessities, obviously. And then also is when newer markets emerge. In the 1990s, a lot of communist governments fell, so there was a lot new markets for Coca-Cola, and their stock price soared because they had a lot more sales. One of my favorite ways to invest in a particular industry is ETFs. If you haven't picked up on it already, there's ETFs for pretty much everything. Also, a lot of times the stock of bad or really poorly run companies can go up just because the sector is exciting to the public. Everyone was excited in buying marijuana stocks in 2018 because of all the new laws passed, but by the end of 2019, these all completely plummeted, which again is why it's so important to look at a company's fundamentals and their PE ratio. You also want to consider the long-term demand for a company's products or services. For example, you wouldn't want to go and invest in Blu-ray because, everything's moving online now, and there's really no demand for Blu-ray anymore. Here are some of the mega trends affecting industries and sectors right now. Right now, there's more senior citizens living in the US than ever. And because of this, companies that focus on healthcare and then finances for elder people are probably going to excel. There's also a lot of advances in technology, internet, medical, biotechnology innovations are just going to keep happening. Obviously, the biggest one right now is AI, but I will talk about that a lot more later in this video. There's also security concerns, terrorism, international troubles, so there's probably going to be a lot more attention to national defense and other things like that. There is also more energy challenges right now, so non-traditional sources of energy like solar, fuel cells, and so on might see an increase in the next couple of years as well. You're also going to want to look at who are the leading companies in those industries. When investing in industries, you have two primary options. Number one is industries that are already established. This is better for novice investors because these companies have already proven themselves and are naturally the safer way to go. But if the industry is hot and you want to have a more aggressive approach, you can look at the companies that have new innovations and are offering things like new products and new technologies. These companies are obviously a lot smaller and more riskier, but just like that oak tree, have a lot more room to grow. Politics can also have a big effect on industries as well. You've probably seen crypto and Bitcoin absolutely explode in the last couple of months because Trump was elected as president, and he is obviously a lot more friendly towards crypto. So you've seen stocks of places like Robinhood and Coinbase shoot up. But Trump also isn't too friendly to a lot of the EV credits, I believe. So I know he's buddy-buddy with Elon, but I could see him getting rid of those federal EV credits, so that might hurt the companies that are already struggling like Rivian. One sector that I absolutely love is precious metals, and that's because these do a very, very good job of hedging against inflation. At the beginning of 2022, I was lucky to make a lot of money from a gold ETF. Its ticker symbol is GLD, and this is a great one to diversify your portfolio a little bit, especially in times of inflation. Silver Share Trust, ticker symbol SLV, is also another great one. Now, if you're an investor that has a relatively small amount of money that they want want to invest in newer companies, then this part of the video is for you. Out of all the types of stocks, small cap stocks exhibit the most amount of growth, just like that oak tree versus redwood tree that we talked about at the beginning of the video. But a lot of those companies are stepped on, choked out, and deprived of sunlight by other trees. So for every small cap company that becomes a Fortune 500 company, there's thousands of others that get choked out. So when buying small cap stocks, I recommend two things. Number one, make sure that that company is at least somewhat established. I like to see 3 years of business, and that company is profitable with their profits raising over 10% for at least 2 years. I also like to diversify. If I want to buy 100,000 stocks of one company, instead of buying 100,000 stocks of one company, I would rather buy 20,000 stocks of 5 different small companies. Also, let's say you bought 1,000 stocks of a company and it went up by several 100%. I usually like to sell some of that, at the very least, sell what's equal to your initial investment. So if that company does tank in the future, you at least got what you initially put in. Now let's talk about initial public offerings, or IPOs. This is the first offering of a company's stock price when it goes public. There are 2 types of IPOs. The first is a startup. In other words, that's when a bunch of entrepreneurs get together and say, hey, let's make this business happen. And then they find an investment broker that puts it on the stock exchange and they get money that way to fund it. The other one is when private companies go public. So this is companies that have already been established in business, but they're looking for expansion capital. If you were to guess which one of those are probably more risky, you would be right if you said the startup, because the private companies already have record of doing some business. Some great examples of successful IPOs is UPS and then Google. Those were both established companies before they went public. IPOs do have a very bad track record, with over 60% of them losing stock value. So for investors, the lesson is pretty clear here. Wait to invest in a company until they have a proven track record. If you do invest in a company with an IPO, you're not actually investing, you're speculating or gambling. A good time frame is to wait usually 1 to 2 years before you have enough data to make an informed decision. If you're looking to choose a stock, it can be a daunting process because there's literally thousands of stocks to choose from just in the US. And then if you enter into the global stock market realm, there's thousands more. So where would an investor look, especially a beginner? Remember, you're making your choice off of the financial data that a company has. And that's why I love something called stock screeners. There's tons of websites with these screeners that pretty much you set in parameters, and then it shows you stocks that fit those parameters that you set. My favorite stock screener is from yahoofinance.com. And let me tell you, after you familiarize yourself with stock screening tools, they're pretty much impossible not to use. You're going to be hooked on them, and I wish I knew about them sooner. So I'll run you through the basics of using a stock screener. Minimums and maximums are the yin and yang. You're pretty much going to set mins and maxes for all the different categories that I'm going to show you. Some sites use greater than, equal to, or less than, but it's all the same thing. First, you're going to want to choose the region. If you're looking for US stocks, of course, you're going to want to choose the US stock market, but you can also choose different countries too. You can then choose market capitalization. You got small cap, medium cap, large cap, and mega cap. Like I said at the beginning of this video, if you're looking for more growth, choose small or medium cap. But if you want more stability, then choose large or mega cap. You can then choose your price, choose the sector, the industry, and then after that, you can start to get into the nitty-gritty stuff if you want. You can pretty much filter for anything. There's 52-week highs, lows, changes in price and market cap, total assets, total current liabilities. But one of the biggest things that I like to focus on is, of course, the price to earning ratio. Like I said earlier, this is the heart and soul of the company. All things considered, I usually prefer my PE ratios below 20, below 25 is also acceptable. If I'm looking for a growth stock, it should usually be below 40, unless there's some other circumstances that aren't being reflected in that PE ratio. I also like to look at the price to sales ratio. I look for close to 1. That usually means it's very reasonably priced, or, if you're a value investor, you might even say a bargain. And then, of course, if you're an income investor, you can also put in dividends into that stock screener. And the most popular stock screening websites like yahoo.com are also going to have ETF screeners as well. They work just like stock screeners, but they filter for ETFs. And you don't necessarily have to go to a website like Yahoo Finance to get a stock screener. In fact, most brokerage apps have them built into the app. Also, most of those websites and apps allow you to save your parameters so you don't have to go through and manually enter it all in again. And listen, don't go nuts with setting all these parameters and trying to find the perfect stock because it doesn't exist. But if you find one, let me know. For investors, the best approach is to focus on the key fundamentals. A winning sector and industry, meaning that sector and industry is growing and doing well. Market leadership, meaning that company ranks among the best in its industry. Profit, so the company is consistently profitable. Sales, so the company has growing sales every year. And then a good balance sheet, meaning that assets are higher than liabilities, also meaning that they have relatively low debt. And then whenever a company has all those and gives you dividends on top of that, that's always great to see. So now you should know enough to be able to go and do your own screening now. So have fun. Now I want to teach you some brokerage orders and trading techniques. So these ones are a little bit more advanced, so don't go into your brokerage right away and start setting all these, but it's definitely important to know at least what these are and how they work. So as I'm recording this in 2025, the market conditions are similar to before big crashes in the past, but investors today can protect themselves just like smart investors did back before those crashes. Now, of course, you can do that through diversifying your portfolio and choosing some defensive stocks, but you can also do that through different order types. So here are the different order types that you should know about. First up is a market order, and this is simply to just buy or sell a stock at the best available price. Let's say that you walk into a shoe store and you don't care about getting the best price and waiting for it to go on a sale. You just want it right now. You would walk up to the counter and pay whatever price it is. That's how a market order works in the stock market. This is the most simple order type. So if I was to just go on Robinhood right now and buy Tesla, this would be a market order. It would buy at the best available price. Next up is a limit order, and this is where you buy or sell a stock at a particular price. So let's say I went into that same shoe store and I wanted a pair of Jordans and they were currently at $50, but I didn't want to pay more than $40 for it. I would walk up to the register and tell them if that shoe ever drops down to the price of $40, then I would immediately want to buy it. And that's the same way it works with stocks. Let's say I wanted to buy Apple at $40, but it was trading at $50 right now. I could put in one of those, and then if it ever goes to $40 or below, it would automatically buy that stock for me. And the same works with selling a stock too. Let's say I had Apple at $40, but then if it ever went above $70, I could place the same order and then it would automatically sell for me. Next is a stop loss order. That is going to automatically sell a stock if it reaches a certain price. So let's say that you already had Apple at $50, but you were worried the price might drop and you didn't want to lose too much money. You could set a stop loss at $45. So if it ever goes below that, then your stock will automatically sell. So that way, if it falls all the way to the floor, you're going to minimize your loss. The last one I want to talk about is a trailing stop loss order. So this works just like a stop loss order, but it moves up with the stock price as it goes higher. You can do this by percentage or dollar. So let's say that you bought Apple at $50 and you set a stop loss order of $10. So if it ever went down to $40, you would sell. But let's say Apple went up to $60. The stop loss would also go up with it to $50, so $10 below that, and then it would keep going up with it. And then if it ever hit below $10 of its highest price, it would automatically sell. So a trailing stop loss order gives you a way to let your stock run as the price increases while protecting you from a big loss if the price falls. It adapts to the stock's movement and helps manage both profits and risk. Now, another thing that I definitely wouldn't recommend to beginners, but you should at least know about it, is buying something on margin. So buying something on margin in terms of stock investing is buying stocks with the brokerage's money. So buying stocks on margin is similar to buying a house. Let's say a house costs $100,000, but you only pay $10,000 out of pocket, and then you borrow $90,000 from the bank. Kind of like the broker. If the house value goes up to $120,000 and then you sell, you still made $20,000 worth of profit. Since you only invested $10,000 in this situation, you would have over 200% profits on that. But on the flip side of that, let's say the house price drops to $80,000, you would still owe $90,000 to the bank. Now that is more than the house is worth, and that is very similar to how buying stocks on margin works. So if you're buying on margin, you can make a lot of money, but you can also lose a lot of money. And when you're buying on margin, that money that you're borrowing from the broker also isn't free. You're going to have to pay interest on all that money that you're borrowing. If you look throughout the history of stock investing, people have gotten themselves in a lot of trouble using margin. In 2008, there was way too much margin debt, and then people lost a bunch of money. Same thing happened in December of 2018. People were borrowing way too much on margin, and then when stocks dropped, they were forced to sell their stocks at a loss. And then in 2020, when the COVID crash happened, investors had to sell off their stocks to pay back loans, causing prices to drop even more. So it's just like gambling, high risk, high reward. But something that is pretty much gambling is short selling a stock. So pretty much everyone's familiar with buying a stock and holding it for the long term. But investors can actually bet on a stock price falling. This is called a short sale, and here's exactly how a short sale works. So imagine you were back in middle school and you had a rare Pokemon card, but you believed its value was going to drop soon. You would sell that Pokemon card and then you would plan to buy it down the line when it is at a lower price to keep that extra money as profit. That is pretty much the same way shorting a stock works. So as you would expect, you can make a lot of money with this if you successfully short a stock. But if you're wrong, and the stock goes up in price, you can lose a lot of money. Technically, there's no cap actually on the amount of money that you can lose. So a lot of traders like to use those orders that I talked about earlier. So they would use something like a buy stop order and a canceled tell good order to limit their losses in case it did go the wrong way. So just like the things I talked about before, you can make a lot of money with it, but I definitely wouldn't recommend it to any of beginners. Just leave it up to those day traders. Hopefully, if you're watching this video, you're going to be a long-term investor just like I am. And the reason that you're buying a stock is to hold it for the long term or until you see some red flags with the company and decide it's not fit for your portfolio anymore. So if you're watching this, you've probably heard that AI is going to have a big effect on people's jobs. I predict that there will be some jobs that will go away, but AI is also going to create new jobs. This isn't the first time that there's been a new technology in the world. And just like the internet, it got rid of a lot of jobs, but it also brought along a lot of new opportunities as well. For the watcher at home, I would advise you to actually use AI as part of your investing plan. You can use an AI tool by simply just asking it a question. If you go to something like ChatGPT, all you have to do is put in a prompt and it'll give you an answer to exactly what you put in. If you want to test it out, just go to ChatGPT. I'm sure most of you have already used it, but if you haven't, just ask it a question as simple as what stock should I get? Or you could ask it other simple questions like give me the difference between mutual funds and ETFs. ChatGPT can pretty much teach you any aspect of investing. If I want to get some investing advice from it, I like asking it about the pros and cons of a given sector, ETF, or any specific company. AI shouldn't think for you, but it can definitely give you a lot of knowledge when you're doing your research. Another great free tool is called ChatPDF. It works just like ChatGPT, but instead of putting in a text prompt, you just upload a PDF and it'll automatically scan it and then answer any questions that you have about it. But regardless if you use ChatGPT or any of the other AIs that are coming out, the key to unlocking it is in the prompts that you ask it. The better questions you ask, the better answers that it'll give you. You could ask it something as simple as what are stocks, but if you want more value, you're going to have to up the quality of your prompt. Let's say I want to retire early. You could say something like, I'm 62 years old and I'm risk adverse. My total investable portfolio is $500,000. I expect to receive annual Social Security income of $25,000 and my annual expenses will be $40,000. What should my portfolio composition be so that I can make enough money in order to cover my expense needs? This way, it's going to give you a lot better answer than if you were to just ask it a more generic question about what you should be investing in if you're retiring. What I like to put at the end of a lot of my prompts is explain it to me like I'm an 8th grader. The average reading level in the United States is actually 8th grade, and if I ask ChatGPT to do this, it usually explains things in a lot more understandable way. AI's biggest drawbacks is that number one, it's biased, and then number two, it's not always accurate. Sometimes it'll just completely make up sources, so you obviously shouldn't just trust it. You should, one, verify what it says is actually true, and then two, obviously talk to a human before making any investment decisions that you're not comfortable with. There's also another way to use AI to boost your investment portfolio, and that is to actually directly invest in AI stocks. So there's two kinds of AI stocks: large cap and then small cap. Most of the large cap stocks you're probably already familiar with. That's going to be things like Apple, Microsoft, and Nvidia. And then the small cap stocks are going to be more obscure companies, but of course they have higher room to grow. And keep in mind, at the time of me recording, there are no pure large cap AI stocks. What you're going to get is companies like Apple, who uses AI in their products, obviously, and then Nvidia, which is a company that makes chips for the AI. But as of right now, most of the open AI companies are private companies. And just because something claims to be an AI stock or they use AI in the company, don't go crazy over it. Like I said earlier in this video, I think a lot of these companies' prices are going to absolutely crash. Like I mentioned, every couple years there's a new fad that goes on. Like in 2018, it was marijuana stocks. And then in 22, it was EV stocks. And we've seen both of those stocks plummet to the floor. So there's going to be a lot of AI stocks that crumble as well. So make sure you're still sticking to your basic fundamental analysis when looking into a company to invest in. Make sure it's actually profitable and preferably more than 1 year. And not just 1 year, we want to see profits year after year. And then of course, make sure they have strong fundamentals so their balance sheet and stuff like that looks good. And of course, you don't have to invest in an individual AI stock. You can go with an ETF. One of my favorites is Robo. That's an ETF that focuses on a lot of AI and then robotics companies. And then there's others as well. There's also other ways to indirectly invest in AI. For example, you could invest in the industries and sectors that will be positively affected by advances in the technology. For one, there's healthcare. The healthcare sector is very data intensive and AI is going to help save them a lot of money. There's also online retail, which is another data intensive company. Manufacturing can also benefit by AI because of the streamlined assembly line. And then there's industries that can also benefit from the negatives of AI. For example, I think cybersecurity is going to do pretty well in the next couple of years because with the advancement of AI, there's going to be a lot more fraud on the internet. So cybersecurity can help both individuals and businesses protect their information. All right, so now I want to pivot and talk about something that isn't quite as fun as AI, but is probably more important, and that is taxes. So let's talk about number 1, how taxes are going to affect your investments, and then number 2, how to keep more of your money from the taxman. So the IRS is going to take your money from investments in one or two ways. The first is ordinary income, and then there's capital gains tax. So if you're taxed by ordinary income, that's going to be whatever tax bracket you're in. For example, if your tax bracket is 28%, your investments are going to be taxed in that as well. And then the amount of capital gains tax that you pay is going to depend on how long you hold your investment. So if you've held the stock for less than a year and then you sell it, you're going to be taxed short-term capital gains tax. So that's going to be the same as your ordinary income, and it's going to depend on what tax bracket you're in. Capital gains is going to be between 0 and 20%, and that's also going to depend on what tax bracket you're in. If you get dividends, that's going to be taxed as regular income, but the good news is you're not going to have to pay capital gains tax unless you actually sell a stock at a profit. So let's say you bought SoFi stock at $10 and then it went up to 20 and you decided to sell. You would then pay capital gains tax on the profits. But let's say you bought that same stock at $10 and then it went down to $5 and you decided to sell. Really, the only positive thing that would come out of that is that you could write that off and get a tax deduction. The max you can deduct each year, though, is $3,000, or if you're married and filing separately, $1,500. Any loss above $3,000, though, can go to future years. But the main thing to remember is buy or sell a stock because it makes economic sense, not for tax reasons. Tax implications are a secondary issue. After all, taxes consume a relatively small amount of your gain. As long as you experience a net gain, you can consider yourself a successful investor, even if you do have to pay your taxman a little bit of that. So some documents that your broker is going to give you that you should keep track of is number 1, your 1099 DIV. This is going to report all the dividends that the stocks pay you. Next is the 1099 INT. That's going to report the interest earned on your investments. There's then the 1099B, and that's going to be the money that you get from selling stocks or mutual funds. And then some ETFs send you a K1, and that's just going to show you your share of your expenses and income. Also, keep in mind, if you borrow on margin, you can actually deduct all the interest. However, things that you can't deduct is financial planning and investment seminars, any costs connected to attending stockholder meetings, or any home office expenses for managing your investments. So if you're planning on investing long-term, like for retirement, you should definitely look into tax advantage accounts. These accounts help you grow your money while also reducing the amount of taxes that you have to pay. So the first and the most popular one is an IRA. IRA stands for Individual Retirement Account, and it's a special account that can save you a lot of money when you're investing for retirement. So there's two kinds of IRAs. The first is a traditional IRA, and with this one, you don't pay taxes on the money you put in it. Then when you take it out after 59 and a half, you pay taxes on it like it's regular income. Opposed to a Roth IRA. With a Roth IRA, you pay taxes when you put money in it, not when you pull it out. Each of these have a cap of $7,000 each year, and if you're young like me, this is honestly the best way to have your money grow for retirement. Then the other popular tax advantage account is a 401k. This is a company-sponsored retirement account, and just like a traditional IRA, your money's going to grow tax-free until you take it out. And the max you can put in there if you're under 50 is $23,000. The advantage of these is a lot of companies match what you put in there, so it's essentially free money from your company. And if your company offers a match, you should definitely take advantage of that because you're getting 100% return on everything they match. So make sure you definitely max out what they match. All right, so now the last part of this video, I want to give you some advice for investing for the next couple of years and tell you what I'm personally investing in. So at the time of recording, we're living in some pretty crazy times right now. The debt in the United States is now greater than it's ever been. Federal debt is much higher than GDP, and interest rates for everyone are higher now than they were at the time of the crisis in 2008. And 2023 was the worst year for housing in a generation. However, the stock market is at an all-time high right now. So what is an investor like you supposed to do? And the good news is the basics of finance have been the same since the beginning of the monetary system. Every individual, household, business, even the government operates under the same rules to achieve financial success. Make sure total income exceeds total expenses. Have total assets greater than total liabilities. Make sure inflow exceeds total outflow. If you overspend and use debt to cover the difference, make up for the shortfall as soon as possible to avoid trouble. Focus more on production and less on consumption. And plan for any major purchase like college education, real estate, or cars. Have an emergency fund for any unforeseen expenses so you don't have to rely on something like credit cards. And then don't use high-cost debt to acquire low-value assets. An example like this would be a family that's struggling financially that buys something like a luxury swimming pool. So here are a couple things that I'm looking out for in 2025. Number one is Taiwan. A lot of people don't think twice about it, but it's actually an independent country, and China's made it very clear that they want Taiwan back under their control. Now, the reason investors should care about this is because 80% of the world's computer chips are actually manufactured in Taiwan. So if they went to war, then there would be a big shortage of computer chips, and chip manufacturing companies from other countries would see a big increase in their stock price. Overall, in my opinion, the market is just way too overbought. You can see in the last 5 years, the stock market has absolutely exploded. People are still buying up companies with PE ratios over 50 like it's nothing. In fact, PE ratios for most companies are just way too high. However, I don't really see a crash coming. I think the market sentiment is so high and people have so much trust in Donald Trump that the market is probably just going to keep rising. Eventually, we're going to see a big crash, but I don't really see that happening anytime soon. But even if there is a big crash, all that means is that the market is essentially on sale and you can buy all the stocks at a way better price. So either way, I'm not really too worried about it. My strategy is to just set up reoccurring payments so every single week I have new money going into the stock market, and of course keeping a little bit of money on the side. So if the stock market ever does crash, then I'll have some extra money to go ahead and buy into it. So now I want to finish off by telling you what is in my personal stock portfolio. So the biggest portion of my portfolio right now is in SPY, which is the S&P 500. I have 50% of my portfolio in that. Like I said earlier, that is an ETF that has the 500 biggest and most important companies, and that's probably always going to be the biggest holding in my portfolio. Then have 15% in SCHG. This ETF tracks companies with high growth potential, primarily in technology and consumer sectors. I then have another 15% in SCHD. That is another ETF that has high dividend paying US stocks in it. This ETF has strong companies that have a really good track record of paying high dividends in it. A lot of these companies are considered lower risk, and since I'm young and I don't need the income from the dividends, I just have it reinvest in buying more stock. I then have 5% in gold. That is a gold ETF that tracks the price of gold. Like I said earlier, this is a really good way to hedge against inflation, and it's done really good for me since I added more of it to my portfolio in 2022 and a more defensive position in my portfolio. I then have 5% in a REIT called Stag. This is a real estate investment trust that I just bought pretty recently. They pay a very strong dividend, which of course I just have reinvest. And this is another great way that I diversify my portfolio, as well as getting some great dividends. And then my last 10% is in individual stocks. These are stocks that I've handpicked myself. I have a lot of different random companies that I have very small holdings in from over the years. One big move that I made is that I recently just sold Tesla. I sold it at about $400 because I just thought it was overbought, and it's down to $350 right now, so that's looking like a pretty good sell. If it drops below 200 again, I'll probably add it back to my portfolio, but for me right now, that PE ratio is just way too high. I made this video because there's a lot of shady influencers out there that just sell their crappy stock investing courses. So I wanted to make one for free that hopefully you guys found some value in. If you guys did find some value, it'd help me out if you just dropped a like button. I post mostly credit card stuff, but depending on how this video performs, maybe I'll post some more investing stuff. I'll see. Also, of course, none of this is financial advice. Please don't sue me. These are just my personal opinions. And also, this is just the way that I've set up my portfolio. Set up your portfolio where it matches your needs. Don't just copy mine unless you want to.